Hello everyone, this is Professor Kent and today's recording is for chapter part 2 of financial advanced accounting volume 2 review, and I'm just carrying forward the review. And this question was part of your test number 2, or it was part of your midterm. Again, you need to know what you're when you're reading the question. When you read the question, you need to make sense of the question. First of all, if you are given a dividend, so if you're given dividend, we pay dividend to both common shareholders and preferred shareholders. And then when you do that, if the preferred shares are cumulative, we only deduct current year's dividends, and we only deduct preferred dividends. So if you have preferred shares and common shares, if we give you a total dividend, that total dividends include common and a preferred, and you only deduct the preferred shares dividend. You do not deduct the common share dividend that are paid to the common shares. So we wanted to know first basic earning per share. What is your basic earning per share? Will be your net income minus your preferred dividend, and then divided by the number of dividend divided by your weighted average shares outstanding. Weighted average shares outstanding. When you do that, what do we start off with? They have to tell us the net income, and they told us the net income is 600,000. In this question, they did not even tell us any dividend. If you don't tell any dividends, we don't deduct it. If there was a dividend given, you only deduct, this is what it is, only deduct preferred share dividend. So this question will be not a big question. It will be in a form of multiple choice question for your final exam. So we have is number of shares outstanding. If they don't tell you when they were issued, then we take it that this was weighted average shares outstanding. So what we do is we calculate basic earning per share. So we calculate basic earning per share, which is $1.50. And you wanted to know if you have options, you can have a we use a what if method for if you have if you have a bond or a debt. If I were to say bond and a debt can be converted into common shares. You have a preferred shares that can be converted into common shares. And we also have options that can be converted into common shares. So when you're doing it, when you have a bond or a debt, what do we pay them? We pay them interest. So if you pay an interest, it's an expense. Interest expense sits on my income statement, and then we need to account for my taxes. If you have a preferred shares, what do we pay them? We pay them a dividend. Dividends are paid after tax income, and there's no it doesn't sit on my income statement, so we don't need to account for it. Now the first thing we wanted to test them on its own, we wanted to know are they dilutive or anti-dilutive. So the word dilutive, dilutive means anything that make my earning per share go down will be diluted. When we call it anti-dilutive, anti-dilutive is anything that make your earning per share go up. It is anti-dilutive. If it's a bond or preferred share or options, they're anti-dilutive. We ignore them from the when we calculate dilutive earning per share. Anti-dilutive bonds, preferred shares, or options are excluded from our basic when we're calculating dilutive earning per share. So let's see what we have. In this case, you could have a preferred shares that are converting into common shares. They said that it is we have it. In addition, Cali has 5,000. If I say 5,000, each bond is 1,000. So that's what it is. Each bond is into 1,000. So bonds are issued at 100, 1,000, or 10. So that's 500 bonds. Each 1,000 bonds. So each bond is for 1,000. And what we do is we multiply by the interest rate, which is 7%. since it's an interest, we multiply by 1 minus your tax rate, and that is my top number. My top number is 245. At the bottom is we have to look at it, 5,000 bonds. Each bond is 1,000. They said that can be converted into 20 shares. When you do that, you divide it by 20. So they said that into will be converted into common shares after June 30th 20. So I will have to debit, at the top I do 6/12, at the bottom I do 6/12. So when you do that, I have a 245 at the top. At the bottom I have 100,000, because these two cancel each other out. So what we have is we calculated on its own, and that we calculate a earning per share. This is more than the basic earning per share. We call it a dilutive earning, anti-dilutive. So we call it anti-dilutive. If it's a more, it is anti-dilutive. If it's an anti-dilutive, then we say basic earning per share. You have to rewrite it. My basic earning per share was my net income minus your preferred divided by 400,000. So that is my basic, which is $1.50. My basic earning per share, and dilutive earning per share is dilutive earning per shares is the same. So when you have a preferred, first thing is when you have a preferred share, we pay them dividend. If you pay them dividend, there's no tax component on the dividend. So this is chapter 18. Chapter 18, you were never tested before. If you were never tested before, you are going to get a big question. When you get a big question, you always start with accounting income, and we calculate our taxable income. We start with accounting income. We have two difference. First one is a permanent difference. It is either taxable or deductible only that particular year. And then we also have a reversing difference. Reversing difference is going to reverse by itself in the future, because not by reverse by itself, but we are going to have a reversing difference in the future. That's what happens. So we needed to see what are we doing with each one. When you have it's a gross profit on installment sale. So when you have a gross profit on installment, we only pay taxes on the cash. So what we have to do is, they said, so of course there's a gross profit on installment sales recorded on the books was 100,000. Gross profit collection was our collection was 50,000. So we only collected 50,000, but if I were to think that if you have a sale, you have a sale of $100,000, and then what we did is my collection means my cash sales. My cash sales are only 50,000. So what we needed to do is, we only pay taxes when we receive it. So what we're gonna do is, when you do that, first of all, it's a reversing difference, and we are gonna call it is for installment sales. There's different way of doing it. Either you take a difference between those two, or the best to do is to take out the total sales. I took out the total sales. I'm going to add back the sales that we're supposed to pay taxes on. So this is from the accounting perspective. This is from the tax perspective. I pay taxes on the cash sales on the installment. So the difference will be a negative 50,000. So you take out the total sales, and you only pay taxes on the sales that we're supposed to pay taxes on. Golf club dues are permanent difference. If they're permanent difference, golf club dues, it is treated as an expense when you have a accounting income. If I needed to do that, expenses are subtracted, so I needed to add back a golf club dues. So golf club dues, the reason why they do it, because we are not earning any sales while our presidents and the vice presidents are playing golf. If they're not, government is not getting any money. If they're not getting money, I needed to add back the 3,800. Now going further, so they said that machine was acquired for 300,000 using a straight line under a straight on a 10-year life for the tax purposes as the CCA. So it's a depreciation is an estimate. If it's an estimate, we want it's going to be a reversing difference, anything to do with an estimate. So what we had to do is we needed to add back the depreciation expense, and we have to take out the CCA. So add back depreciation minus the CCA. If I were to do how much was my depreciation, I'm going to calculate it here. They didn't tell us. 300,000, and I divided by 10, and that is my 30,000. I will add back the 30,000, and I will have to subtract the 42,000. That is my current year. My sign, because my bigger number is my negative, so that will be your minus the 12,000. Going further, we have a dividend that you received from Canadian Corporation. They're not taxable. If they're not taxable, I needed to take it out. I will take out 4,000, and it is a dividend. Now, if it's an estimated warranty liability, we only allowed to deduct the actual. So I add back my warranty expense. I minus my actual warranty. You can also have a pension. You can also have a impairment. Anything that is calculated using the estimate, you needed to adjust for the accounting income. So 19,600, I will add back. I will deduct the cash that was paid. Difference between those two will be 6,000. In other words, if it's a 6,000, my positive number is higher. If your positive number is higher, you're going to add the 6,000 here. So let's go further and see what this thing is. Now they told us my accounting income. My accounting income is 25,000, and I'm going to do is I'm going to add and subtract. I'm going to do this further, so you could do it, or what you could do is it's good to do it further because I needed to only do one entry. So if I were to do that, I will have, sorry, I needed to go get a calculator. I will have 50. So I have negative 56,000. So I know that if it's a negative, I will create a deferred tax liability. If it was a if it was positive, it will be an asset. So I add and subtract. What do we get? I get a taxable income. My taxable income is 193,800. So the question will be to prepare all the entries. When you're preparing all the entries, the first entry will be to calculate my income tax payable. So my first entry will be current income tax expense, income tax payable. And how much will be my taxable income? 193,800. We are in 25% tax bracket. I multiply by the 20%, and what do I get? I get a number, and that will be 48,450. 48,450. My second entry will be, again, we're doing a combined entry. If you're doing a combined entry, what you're going to do is you have to call it deferred tax expense / benefit. Credit will be your deferred tax asset / liability. The amount is 56,000. I multiply by the tax rate, which is 25%. I have to calculate it. 56,000 multiply by the 25%, and I will get a 14,000. So my entry will be 14,000 here. This will be 14,000. Or you could do a single entry. This is, you are going to do in each one, so you will get a same answer at the end, but you will do a 3 entries. So we decided in the class to do a 1 entry, and we're going to do a combined entry. But when you're doing a combined entry, make sure you have both accounts are shown in the journal entry. So make sure there's both accounts are shown in your journal entry. So let's go further and see where we're going to go with my next question. My next question is to calculate. What are we calculating? We're calculating something. I don't know what we're calculating. All my papers fell. So this is comes from chapter 21. There's three kind of three changes that were shown: change in accounting policy, change in estimate, or correction of an error. So what we have to do is we want to know what it is. Is this a what kind of change is it? Is this none of the above? Change in estimate, correction of an error, or changes in accounting policy. Again, this is also one of your questions in your multiple choice question. Not multiple choice question. This was one of your questions for your assignment number 2. So it's always good to do it. I hope it's not the same question. Sometimes I make a mistake too. So again, you can earn some marks. So let's look at it. In the first one, the company changes method. So when you're changing a method from one method to another, so one GAAP principle to another GAAP principle, and that will be change in accounting policy. So that will be A. So anything, when we think of it, anything we do, estimate, anything that we are learn it, if it says at the year end 2020, an audit revealed the corporation allowance for doubtful account is all about estimate. When it's an estimate, it's just estimate could be wrong. If the estimates are wrong, we call it is a change in estimate. Now, depreciation is one of the methods. So depreciation is one of the method of depreciation methods are all about estimate. We wanted to know, is this because of a change in estimate or they made a mistake? We needed to know what they did with it. Is this impact is due to change in estimate or something else? Depreciation on a truck was understated because the service life had been overestimated. The underestimate had been made in order to show higher net income. So now they're not doing it because this mistake, this was due to that they wanted to report higher net income, so they reported less depreciation. So if that's the case, it's not that because of change in estimate or change in life, it's just they wanted to do this. So this will be mistake. If it's a mistake, it's a correction of an error. So when we switch from one accounting method to another accounting method, so what we do is we switched from weighted to FIFO is switching a method from one policy. It's switching a method. It's a GAAP principle. If you're switching from one method to another method, it will be change in policy. If it's a change in policy, it's done retrospectively. Correction of our error also done retrospectively. Change in estimates done prospectively. So it will be done prospectively. So going further, we have my next one. It says we sort of introduced a new pension plan which included past service cost, decided to recognize 50,000 as a part of the pension expense. Of course, past service cost is a part of the pension expense. We learned it in chapter 19. If it's part of the pension expense, then we recognize it good. We will do nothing for this one. Going further, we have during the 2023 long-term bond with a carrying amount of 30 was retired at the cost of 41,000. There's nothing wrong with it. So you retire a bonds, you have a loss or a gain, but there's no mistake. Means they retired at 41, they could have a gain or they could have a loss. So if they retire it, there's nothing wrong with it. Number 7, we said after negotiating with Canada Revenue Agency, income tax owing 22 was established at 42,000. The original estimate amount was 28,000. So we estimate how much we owe without doing the income tax return. So what we did is we estimated it. So our estimator was incorrect. So what we have to do, it is a change in estimate. Going further, We are going to go to next one as my in 2020. uh, in 2020, the company incurred interest expense of 29,000 at 20 years. So you have an interest of 29,000. It's a liable expense. If it's a liable expense, then we don't need to do anything. It is my D. Now, what happens is when calculating the depreciation in 21 for the building, an error was made which overstated the net income. The error was discovered in 23. So if it is a correction of an error, we needed to do prior period adjustment, and that will be your C. Let's go from the other one. What we did is we changed a depreciation method. So if you change the depreciation method, like I said that any depreciation method is an estimate, and then what we do is we do it prospectively. So that will be your B. Change in estimate will be your B. So change in depreciation, change in life of an asset, they all will be they will all be part of your change in estimate. If it's a change in estimate, we will do it prospectively. So now what happens is these are some of the correction of an error, and then what we needed to do is where this come from. This come from chapter 21. I think there is I think there's an assignment question on this, but I'm not too sure. What they did is they give us our trial balance, and then from there they give us additional information, and then what we needed to do is we needed to do entries. We're ignoring the income tax. If we have an income tax, we could have a deferred tax asset or a deferred tax liability, but we needed to do an adjusting entry, or we have to do a correcting entry. We made a mistake, or we have to fix the mistakes. A physical count of supplies on hand December 31st was total to 3,400, though through an oversight, the salaries and wages count was not charged. Okay, well, before we get there, I needed to do my first one because it seems like there's two entries in the same. So when we do a physical count at the end of the year, in our supplies account, it shows that there's a balance of 6,700. The balance we have is 3,400. We need to do an adjusting entry. What will we do an adjusting entry? Debit will be your supplies expense and credit will be your supplies. How much will be? If I do a T account, I have a balance of 6,700. I need 3,400. I will do an adjusting entry for 3,300, and this is your supplies account, and that will be 3,300 here. This will be your 3,300 here. Going further, they said through an oversight, salaries payable account was not charged. If we did not charge the salaries payable account, and what did they say? And payable during 2023, accrued salary wages on December 31st 2023 was 6,200. So the balance, what we need is the balance we need is 6,200. So what we have a salaries payable account. The balance is 4,900. I need a balance in my payable of 6,200. So if that's the case, I needed to do an entry, and this will be my my payable needs to be increased. If your payable needs to be increased, debit will be my salaries expense, and credit will be my salaries payable. And then what I'm going to do is I needed to do an entry for 1,300. So that will be the entry for your 1,300. So that's my entry. So going further, what we have is we have interest receivable account. What happened to your interest receivable account was left unchanged. Accrued interest in the amount was 6,750 on December 31st. So what we did is we have some amount, and what we needed to do is we needed to adjust our receivable. The balance we have is 7,300. The balance we need is 6,750, and what we needed to do is we have too much in there. I needed to take it out. So the difference between the both, I will do interest income and receivable goes together. So I have an interest receivable. So I will take my 7,300 minus the 6,750, and I needed to adjust it, and the amount of my adjustment will be 550. Going further, we have number 3. They said the unexpired, so this is unexpired, so the word here is unexpired. So I have insurance in my account. I don't even see any own insurance account here. Oh yeah, I do see it. We have prepaid insurance, and the prepaid insurance that is sitting here is it is sitting here is 108,000. We need a balance of 42,000. So what we're gonna do is debit will be my insurance expense, credit will be my prepaid insurance. How much will be prepaid insurance? And the amount will be I will have 108,000. That's the balance. I need a balance of 42,000. Difference between the both will be 66,000, and that's what we have to do in adjusting entries for 66,000. Going further, number 4, what they're saying, a revenue, a check of this was received on January 1st, 2023 for the rent building, both 23 and 24. The entire amount was credited. So this case, they told us it's this rent that we have is 72,000. It is for both 23, 24. If I have 2 years, I divide it by 2, so that is my 36,000. Some is my rent that belongs to my 23, some belongs to the following year. If it belongs to the following year, I received it, so I will have to adjust my rent revenue count, and I have to put it in unearned rent revenue because that's a liability. For 2024, I will debit my rent revenue for 36,000. I will credit my unearned rent for the same amount, so I will do that. So going further, my next one is my next entry is for number 5. They said depreciation equipment for the year recorded as we recorded as 4750 rather than 47. So there is a difference between 47,500 minus what we record. We just omitted a 0, so the difference between the both will be 42,750. If my books are not closed, I needed to do an adjusting entry. My adjusting entry will be debit will be my depreciation expense, credit will be my accumulator depreciation. The amount of my accumulator depreciation will be 42,750. 42,750. Going further, what happens in this case? A further review of prior depreciation calculation revealed that the depreciation equipment had not been recorded. If it's not recorded, that means we made a mistake. Which year it is? It's a previous year. If it's a previous year, it becomes a prior period adjustment. If it's a prior period adjustment, if it's a depreciation expense that we did not record, the impact on that will be my net income will be over. If my net income is over, my retained earning is also over. How do I fix it? By bringing it down. How do I bring it down? By debiting the retained earning. So my debit will be retained earnings. Retained earnings, so RE stand for retained earning. The amount of the retained earning will be 18,500, and my accumulator depreciation account is a permanent account. It doesn't get closed, so I needed to adjust my account by 18,500 to adjust for this. So I am going to record it. I have another question to do, and that question is for the income to prepare a cash flow statement, and this question is also big. So what we have to do is I will have to record another video for that, and I will try to do it tomorrow. Thank you so much for listening to me. And thank you for subscribing to my channel. Stay tuned to part 3 for the review. Again, make sure you practice everything. Before you practice your review, make sure you go through the PowerPoint so that you can practice this fully without looking at the solution. So or what you could do is you could do the questions as you watch the video. Whatever you find it easy, that's the route you're going to take. Thank you so much for listening to me. Take care and bye for now.